हेलो एवरीवन, वेलकम टू अनदर एपिसोड ऑफ इन कॉन्वर्सेशन बाय एडवाइजर खोज। आज के इन कॉन्वर्सेशन का हमारा पॉडकास्ट बहुत ही इंटरेस्टिंग है क्योंकि दिस इज आवर 100th पॉडकास्ट बाय एडवाइजर खोज। एंड टुडे इन दिस 100th पॉडकास्ट आवर गेस्ट इज मिस्टर राजेश आयनर, इन्वेस्टमेंट लीड SIF विद यूनियन म्यूचुअल फंड। मैं अपने सारे व्यूअर्स को रिक्वेस्ट करना चाहूंगा कि आई एम श्योर आप हमारे वीडियोस पॉडकास्ट तो जरूर देखते हैं, बट जरा सब्सक्रिप्शन बटन भी दबा दीजिए बिकॉज आपको जानकारी आती रहेगी एज एंड व्हेन हमारे ये इंटरेस्टिंग पॉडकास्ट आते हैं वेयर वी गेट वंडरफुल इंडस्ट्री एक्सपर्ट्स लाइक राजेश। थैंक यू वेरी मच। सो राजेश, वेलकम टू इन कॉन्वर्सेशन एडवाइजर कोर्स टुडे।
Thank you, Surenji, and congratulations to you and your team for completing the milestone of the 100th episode.
थैंक यू सो मच,
Thanks a
बहुत बहुत
lot.
शुक्रिया, बहुत बहुत शुक्रिया। तो राजेश, बिफोर हम प्रोडक्ट में चलते हैं आगे और बहुत सारी बातें करनी है आपसे, इफ यू कुड जस्ट टेक आवर व्यूअर्स अबाउट योर इन्वेस्टमेंट मैनेजमेंट जर्नी एंड एक्सपीरियंस।
Uh, yeah, thanks. Good way to start. I have been in the investment management industry, you can say, for about 23 years, right since 2003. Now, beginning of the period, I was on the long only side. I have worked with various mutual funds like Tata Mutual Fund. I was with Mirai Asset AMC. I was also with an insurance company, MetLife India Insurance, for quite a substantial time. And in 2017, I actually shifted the side and joined the long short industry. It was one of the early entrants in Indian long short space. Entity named ITI Long Short Equity Fund. So I was managing that fund for around 7 years. Uh, it's been you can say since last 9 odd years I'm in the long short space. Now,
हम्म।
having seen both the long only as well as long short sides, I would say that shorting and managing a large long short AUM, it requires a different mindset versus how it is done in the long only side. The concept of preserving capital during the
हम्म।
downside and actively managing the portfolio risk has a slightly more bearing on the long short portfolio
हम्म।
construct at times. Um, Now, interestingly, as they say, what goes up must come down, which invariably holds for all the markets in the world. The focus on preserving capital during the downturn, what it allows is to manage the portfolio volatility, which in simple words is the portfolio risk in a much better way. The
हम्म।
objective is to focus on the entire market cycle and deliver a better risk adjusted return versus trying to outperform in a specific rising market phase or outperform in a falling market phase. It's basically an entire investment cycle in its entirety that is the focus at most of the times.
हम्म। वंडरफुल, वंडरफुल। सो मतलब कि लॉट ऑफ एक्सपीरियंस ऑन द लॉन्ग शॉर्ट साइड फॉर यू।
Yeah, almost 9 minutes, I would say. Still too less to learn anything.
So Union Mutual Fund is launching their SIF, the Arthya Equity Long Short Fund, on 4th of May and closing on the 18th of May. So agar you could take our viewers through as to what this Arthya Equity Long Short Fund is all about, and of course also an extension आपका investment management process as well.
Yep, surely. So Arthaya Equity Long Short Fund is the maiden strategy under its SIF product launched by Union AMC. The name Arthaya has been chosen after a lot of deliberations. Uh, the word Arthaya is a Sanskrit word which means purpose-led wealth, and the strategies which are, you can say carefully designed and put forward under these products are aligned with the financial goals with very clear objective as to what it is expected to solve.
Hmm.
In this strategy, the objective is to deliver a symmetric return to the investor.
Hmm.
What it means is that during the market downturns or drawdown, the focus shifts to preserving the capital, whereas when the market turns around and starts rising, the focus shifts to having as much higher participation in that rise and trying to capitalize on the market rise. Now, the market always moves in cycle. No market around any geography or around any asset class is an exception to this. And the approach which I just described, that essentially focuses the entire market cycle, which is comprised of, the rise, then subsequent fall, then further rise and further falls. That's typically the way, markets always behave. And the focus thereby becomes, that over the entire cycle, I need to deliver better risk adjusted returns, which means that the return could be similar, but the volatility which it takes for getting to those returns is curtailed significantly.
श्योर श्योर। एक बात बताइए, मैं हमेशा पूछता हूँ एसआईएफ फंड मैनेजर्स से कि हमारे पास पीएमएस है, एआईएफ है कैटेगरी 3, हमारे पास म्यूचुअल फंड्स भी है बहुत तरीके के, बैलेंस एडवांटेज, मल्टी कैप, मल्टी एसेट। तो एसआईएफ की ऐसी क्या जरूरत पड़ गई एक
Hmm.
तरीके से? मतलब कि व्हाई वाज एन एसआईएफ नीडेड अकॉर्डिंग टू यू? एंड ऑल्सो इन टर्म्स ऑफ कि आपके जो अर्थिया इक्विटी लॉन्ग शॉट है, इसका अगर आप कुछ यूनिक फीचर्स बता सके, विच विल दिस फंड विल ऑफर पर्टिकुलरली प्लीज।
Yep, definitely. See, you have raised a very, very important point that, when you have so many things, why there is one more addition of, product or an asset class or whatever you call it, the long short strategy. Now, let's look at, you have asked the question at two different levels. First is, of course, comparing it with PMS AIF as well as the mutual fund industry. Now, PMS or AIF, these are the products which are typically targeted at HNI or ultra HNI clients, thereby meaning that the ticket size is pretty large. It's 50 lakhs for a PMS product, or it is 1 CR for an AIF product. Whereas mutual funds practically have no minimum investment limit, and you can have your SIP even at 500, 1000 rupees. So in terms of ticket size, it is essentially bridging the gap between these two ends. You have one product which is more sophisticated, more customized, and having certain different strategies suitable for different markets, but that is getting offered only to the ultra HNI and HNI clients. So the idea is that we have to have somewhere in between, which is the best common ground, which offers these sophisticated strategies, but at the same time, it is not so expensive that it is completely out of reach for a large class of people. And that is where the positioning, or I would say the suitability of SIF comes in the picture. Now, another, of course, there are other differences also. What is happening is this product SIF is coming to you via an intermediary, which is AMC, which you trust. And why you trust is because there is a regulator who has put in place, very strict guardrails as to, how this product will be operated. Because, when we talk of long and short, you are actually indulging into derivative space. And that is where, you need a lot of these guardrails. Otherwise, the risk element in the product can actually go on the higher side. So just to give you or explain this point further, typically when we have an AIF3 product, it is allowed to leverage. So if I have a product or an EM of let's say 100 crore, I can actually build positions worth 200 crores in the portfolio by using derivatives. Whereas in case of mutual fund or in case of SIF, there is no leverage allowed. So if I have an EM of 100 crore, my maximum exposure which I can create in the market is also limited at 100 crore. Now, other important part is, SIFs typically have far simpler fee structure. Now, if you look at any other products, there is an element of performance fee or carry, as they put it. Uh, so here, you have a product which is having or running long short strategy, but it is priced exactly same as a commensurate size AMC product. So
Sure.
that I would say is, it makes a lot of difference when you look at 8 or 10 or, any longer term performance, and then try to compare as to how much was given out in terms of performance fee. Another important difference being, SIF is also an equity taxation product. It can be structured like an equity uh,
True.
mutual fund. Whereas if you look at, AIF3, the taxation for the derivative income that you earn from AIF3, that particular thing is taxed at the marginal rate of taxation. and also it is not taxable with the investor. The tax is taken out at the instrument level itself.
Sure, sure.
Now, so that is one part, among the alternates, of course, there is a bridge between your regular mutual fund products and all the alternate products, which is an
Mm,
SIF. However, when we compare it to other AMC products, then the comparison becomes far more, I would say, nuanced and far more detailed. Now, if you look at, any AMC, there are 40 plus AMCs which are operating, and they have an entire bouquet of products.
mm, mm,
But these products are, sort of carefully allowed to
mm,
represent certain need
mm,
the investor has. So, you have complete or 100% equity exposure products, you
mm,
have debt exposure products, and then you have hybrid products. Within equity also, depending on your risk appetite, you have differently positioned products. So among all these, which is the need gap which SIF as a product or as a new asset class is trying to address? So that's an important question, and let's try to look at it in slightly more detail. uh,
sure.
so when I'm positioning an equity mutual fund, the idea is that the fund will always remain invested. So we also have a minimum investment limit, which is typically 80% of equity exposure that the fund must maintain. Now, what it does is it effectively makes the product a market linked product or a beta product. And, even in the downturn, the mandate of the product is to remain fully invested. So it becomes almost fully exposed to the market downturn. Now the fund may keep exposure across market classes depending on the category or the benchmark that it has. But whenever a large fall in the market happens, you are largely exposed in almost uh, your entirety to that fall. uh, Now, in this case, the idea is very clear that if somebody wants to cash out or move away from the market, then that decision lies with the investor and the advisor of the investor.
Mm,
So they
mm,
may think and try to feel that yes, this is not the right market to stay invested in, and they have the option to redeem the
sure,
funds and step out. But fund manager, typically runs with the mandate of staying invested, because
sure.
that is how the product is designed. The other asset class which has come up is the multi asset fund, which you touched upon. Now here what one is trying to do is you are trying to diversify the asset classes and trying to reduce the risk. So
Mm,
I can invest or have a measured exposure across energy, base metal, precious metals, or any of these commodities. I may have some InvITs or REITs also in
mm,
the product. All these things are done so that I reduce my dependence or my correlation to a single asset class, which is equities. Now, in different proportions, you can have them, and because these returns of different asset classes are not exactly correlated, that is how you are trying to, reduce the risk in your portfolio. Now,
sure.
the fund, obviously, the other asset class which is largely there in the bouquet is balanced funds. Now, what balanced funds are trying to do is, let's say you have an investor who does not have that high risk appetite. Now, see again, the same investor at different stages of his life may also have different risk appetite. Somebody who is
Very true.
50-year
Very
old
good.
versus somebody who is 60-year-old will be completely differently
Mm,
uh, positioned as far as their risk appetite is concerned.
mm,
So,
mm,
what balance fund is trying to do is it is trying to lower your risk.
mm, mm,
But in the process, what happens is you're also trying to lower your return potential.
mm,
So let's say when I'm 100% exposed to equities, I will have a certain risk. But if I remain 50% exposed to the same asset class, my risk gets reduced to half. But in the process, my return potential is also reduced by half.
mm, mm,
So effectively, balance funds are trying to sort of plug that need of the investor.
mm,
Now, where does an SIF or an SIF like what we are trying to come up with,
mm,
the equity long short SIF strategy
mm,
fits in, is that it tries to offer a better risk adjusted return to the investor. The objective of the strategy is to reduce the volatility or the risk, whereas for reducing the risk, you don't need to compromise the return potential.
right.
So over the full cycle, which comprises of a meaningful upside followed by a meaningful downside, what I'm trying to do is I'm trying to generate asymmetric return so that over the full cycle, my returns come closer to what a long only strategy will be. However, my risk or my volatility will be reduced significantly in the process. And how is it done? Is by focusing on preserving the capital when your market moves in the downturn. So effectively, that I hope clears the question of how exactly is SIF position, and within that, within AMC space,
Mm.
with an entire bouquet of products, what is the positioning of a long short
श्योर।
strategy?
एब्सोल्युटली, आपने आपने बहुत अच्छे तरीके से एक्सप्लेन किया। तो इन्वेस्टमेंट मैनेजमेंट प्रोसेस की अगर हम बात करें, तो आई थिंक इट इज वेरी मच अलाइक टू अ म्यूचुअल फंड vis-a-vis an SIF, except for the downside protection which this fund definitely provides, SIF provides.
Absolutely.
Sure, sure, sure. And any specific thing on the investment management process which you would like to talk about the SIF?
See, in the investment management process, it is effectively in one side. I'll just explain it right from the beginning, along with how is the portfolio construct,
Right.
because everything flows from there, and we actually have to look at this slightly differently, because when I'm creating position in derivatives market, I don't necessarily need to deploy my cash.
That's right.
So
Mm-hmm.
that is where the entire portfolio construction comes out. Uh, but there is one more caveat, small caveat here, that I still need to maintain an equity taxation.
अच्छा।
And the small catch there is, if I have an exposure in derivatives, let's say I have gone long on 20% of Nifty futures. From the tax lens, this exposure is not counted as equity exposure. So whatever I am buying with my hard cash in terms of cash equities, only that remains my equity exposure. So
Mm,
let's say typically the fund will have at least 65% kind of cash equity so that I retain the equity taxation. And depending on the market outlook and what is the risk reward, because let's say if the outlook is good but the valuation is really super normal, then your risk reward doesn't match up. On the flip side, the outlook is not great but the valuation is really really cheap, then even at that point of time, depending on what catalysts are lined up, the risk
mm,
reward could be more favorable. So
mm,
depending on what is my risk reward which is offered by the situation, I can move the fund exposure between
mm,
0 to 100. That is the
mm,
range of flexibility which is available with a
mm,
long
mm,
short
mm,
strategy.
mm,
So let's say if I think that the market is not really conducive for making good money, or there are a lot of risks which are lined up versus
mm,
whatever is the reward which is left in the market, I can actually lower the exposure to a meaningfully small number. It could be
mm,
20
mm,
or
mm,
30%.
mm,
Now the small catch is I have to maintain 64% equity. So how do I lower the exposure? So that is done by hedging the equity exposure which I have. So let's say if I hold 65% equity and I short 40% out of that by the same stocks which I'm holding in cash equity, effectively I'm shifting my book from equities or long only equities into an arbitrage strategy. So what it will leave me with it is only, let's say, 25% of equity exposure.
sure.
Now, by doing this, what I'm able to achieve is, if the environment is bearish, I can bring down my active exposure to the market to a much lower number.
Mm,
Now,
mm,
flip this situation and market turns around and the environment become bullish. I can actually run it like a long only fund, because in
mm,
that case, of course, my gross exposure is capped at 100 by SEBI. So to that extent, if I'm to increase the net exposure, I have to reduce shorts in the system. And when the market is flat, that's perhaps a better time, because in a flat market, you know, with my ability to go short on the stocks, my universe gets expanded. So let's say typically, if there are, hypothetically, if there are 250 stocks in a long only universe, and I know that I like only 150 stocks, and 100 out of those 250 stocks do not make the cut
mm,
for becoming an investment, good investment for me. So all I can do is I can just avoid buying them. Whereas in a long short strategy, I need to go ahead and further study them,
mm,
so
mm,
that
mm,
if there is an opportunity where the stock price will fall, I can short that stock, and I can make money out of falling market also, or the
Sure,
falling stocks also. So to that extent, it is slightly bigger investment canvas.
sure.
So broadly, this is how the fund construct, and this is how the overall strategy would work. So process would be, yes, to try and identify which phase of the market you are in, how is the risk reward, and if the risk reward is not that great, or there are elevated risks in the environment versus what the market is trying to factor in, you have the option to clearly reduce the exposure. On the flip side, if I think that the market is really conducive and I can make good money in the market, I can increase the exposure and bring it to as high as a long only fund. It could be 85, 90, or 95% exposure. So
Sure,
that is a
sure.
wide range of
तो अगर हम
budget
हेजिंग की
exposure.
बात करें, हेजिंग की बात करें, so in a normal market environment and stressed market environment, what kind of hedging, percentage you could be doing in the portfolio?
Yes, it's a very good question, because what happens is, in the normal market, when I say normal, I'm expecting, let's say, typical. Now, what's a normal market? There are
Hmm.
no surprises either on the positive side or the negative side, which are lined up, and it's a regular market where I know I have to go out and identify which are good stocks to go long on, which are good stocks to go short on. And in that case, let's say if I'm running an 85 or 90% gross exposure, I don't necessarily need to hedge my exposure. Why? Because by hedging, I mean, if I'm holding a certain stock, I will go ahead and short the same stock. Whereas here, what I can do is I can go ahead and buy the stocks which I like and where I think the prices will go up. And I will also go ahead and short the stocks where I think prices will go down. So, in a way, although the shorts are in different stocks, they also act as a hedge and they enhance my return. The other part of the equation is, let's say we are in a stressful situation. By stressful, I would say, let's move back to
Hmm.
uh, you know look at last 1 month, 2 month, or even
Hmm.
last 1 year period.
Hmm.
What we have seen is that there have been a lot of external shocks which were imposed upon us, and those shocks sort of impacted a lot of important things. For
Hmm.
example, your currency took a beating, your interest rates were relatively higher, then your current account was also relatively under stress because of tariff related issues. And when we are trying to come out of all these, immediately we were struck by war. So in these kind of scenarios, I know that it is not really the time to get adventurous and try to do something else to make more money. It is the time to preserve capital. And in these kind of situations, I can do is I can cover my entire portfolio and sit at 0% direct exposure to market. So
Hmm.
effectively, what it means is I will have a portfolio which is almost entirely an arbitrage fund.
I
Of course,
see.
it's a
Hmm.
hypothetical construct, but yes, that is uh,
Yeah,
where one can really migrate to if the situation is a risk of environment, like it is
right.
when the war situation erupted.
Sure.
However, in the normal situation, when I see that yes, there is a definite opportunity to make money in the market, then one needs to get aggressive and come back very heavily in the market, because there are only limited period of times when the market are so good that you can make good money, and then there is a time correction phase, or
So,
there is a
so which means the net equity exposure can be drastically increased or reduced depending upon the valuation and the comfort, the cyclical comfort, typically.
absolutely, you really hit the nail on the head. So that is exactly the idea, that we'll first identify which is the which stage of the cycle that the market is in,
Hmm.
and accordingly you need to take the exposure in your portfolio. You don't need to expose your portfolio to unnecessary risks.
या बिल्कुल सही। तो ये SIF आपके हिसाब से, टू योर माइंड, किस तरह के इन्वेस्टर के लिए सबसे बेस्ट सूट करता है?
So, this is in fact, I'd say, extremely important question, because as I said earlier, which is again coming back to the earlier question which you asked, कि already AMCs के पास इतने सारे products है,
हम्म।
फिर आपका एक alternate space है जहाँ पे और भी कुछ offer होता है, आप और एक additional product लाके क्या, what exactly are you trying to solve, or what is the equation you are trying to address over there?
हम्म।
So the investors along with the advisors, they too are of course like one entity. When I'm the offering any product, they will decide what is the suitability of different products which are offered by AMC. So you have an equity product, you have a debt product, and depending on investors risk appetite, or depending on the market situation, which the advisors may feel that yes, this may not be the right time to push my investor towards aggressive positioning, so they may offer different products which are available. Now, the key proposition with which Arthaya Long Short Equity Fund is coming out with is to offer better risk adjusted return. And this risk adjusted return is offered over the entire investment cycle. Now, how is it done? It is done by reducing the volatility over uh, when the fall happens, because
Mm,
investors do not like to see deep drawdowns in their
mm,
net
mm,
worth or
mm,
in their corpus when market falls, let's say 12, 15, or 20%. So, and then you looked at as to yes, if I have to identify what is the profile of my ideal investor, or which are the kind of investors. Obviously those, this is a common sort of thumb rule that the lower your age, the higher is your risk appetite. So in my early 20s, I will be open to take higher risk. But
mm.
as a person grows and you come into your mid 40s or maybe in your early 50s, that is when the investor is also looking at his retirement. He has also gotten settled in his career or in his business, where his cash flows are also meaningful. तो
Correct.
ये पीरियड है जब आपका बहुत सारा जो लाइबिलिटीज है, लेट्स से यू वुड हैव अ लॉट ऑफ ईएमआईज अर्लियर इन योर लाइफ, तो हो सकता है बहुत सारे ईएमआईज अभी निकल चुके हैं, योर किड्स हैव ग्रोन अप, योर cash flow which is happening to you, they are also meaningfully big.
Mm.
And you also understand that yes, I need to stay in equities if I want to make significant return.
Absolutely.
तो
Mm.
उनको इक्विटीज में आना है, बट ट्राई टू अंडरस्टैंड द इमोशनल नीड ऑफ द सेम इन्वेस्टर. If you flip the situation, let's say the person is in late 40s or early or mid 50s, he knows that his active period till which he will be earning, it could be, let's say 60 is the retirement time. So कि मेरे पास 8 या 10 या 12 साल बचे हैं,
Mm. Mm.
and I also am sitting with almost my entire life's money or earnings with me. So if it so happens कि मैं अभी पूरा इक्विटी में चला जाऊंगा, and let's say when I'm in my mid 50s, 55 or 56 year age, suddenly market cracks, market goes down 20 22%, and my NAV suddenly drops very heavily. They are emotionally not ready for this. Why?
Mm.
क्योंकि आपके पास जो पीरियड बचा है वो लॉस रिकूप करने के लिए वो बहुत कम है.
बहुत कम
You
है.
hardly have 5, 7, 10 years to recoup whatever you might have lost. Second thing is there could be some large expenses which everybody has, in that stage of life. It could be some higher education, it could be some other, marriage related or any other expenses which might be lined up. You may have your mental calculations कि yes, ये खर्चा करना है, वो करना है, and suddenly, market flips and goes the other way. So in more technical terms, we say that the investor has now moved on from wealth accumulation phase to wealth preservation phase, कि हाँ भाई पैसा बढ़ाना भी है, but more important कि पैसा गंवाना नहीं है.
जमाना नहीं है. Hmm.
Yes, and these are the kind of investors for whom a risk adjusted return strategy is ideally suited, because what
Hmm.
the strategy is offering you is, you know, almost full participation in the equity over the entire cycle. But whenever a deep drawdown comes, your NAV will not be hit that harshly.
करेक्ट. मार्केट साइकिल्स आया, वैल्यूएशन डिस्कम्फर्ट आया, करंट सिचुएशन आया, देन ऑब्वियसली देन योर एनएवी इज नॉट हिट हार्ड. करेक्ट. बिल्कुल सही.
So typically, these are the, and see again, I'm just for giving example, I'm giving somebody who is in the late 40s or early 50s, but somebody could be predisposed in a conservative way even
Hmm.
in his 30s.
Hmm.
So to that extent, anybody who values risk adjusted return more versus getting adventurous and trying to put all eggs in one basket, this strategy is quite suitable.
श्योर श्योर. वंडरफुल. सो राजेश, थ्रू दिस इन कॉन्वर्सेशन टुडे, आप क्या एक मैसेज देना चाहेंगे सारे व्यूअर्स को, इन्वेस्टर्स को, म्यूचुअल फंड डिस्ट्रीब्यूटर्स को, एडवाइजर्स को, अबाउट SIF in particular, and also about Arthya Equity Long Short Fund new fund offer? as a closing remark.
Yes, definitely. So, again, to the investor, the clear objective of bringing up this fund, like Arthaya is, as I explained, it is basically purpose-led wealth. So there is a definite purpose with which the AMC has designed and come out with this product in this particular asset class. Within SIF also there are categories, and we are targeting the first category within which a risk-adjusted return product is coming on
Hmm.
the offer. Now, this typically is for those investors who want to have a portfolio which will deliver a return similar to a long only return over 3 to 5 year period, but it will have meaningfully lower volatility
Hmm.
now and meaningfully lower downside participation. So there are both sides to look at. When I
Hmm.
say that
Hmm.
the
Hmm.
drawdown is significantly lower, then when the market comes into a rally phase, obviously this fund will be behind long only fund. So, but that is the way the fund is designed to behave.
Hmm.
That
Hmm.
if the market falls 10%, yes, the fall of this fund will be much lower. It could be like a 3 to 4% fall or even a 5% fall. And when the market rallies after that fall, let's say it rallies 20%. So in that case, the fund will not go ahead and chase those returns. It will be contained at maybe 13 to 14 or 15%
Hmm.
return.
Sure, sure,
And
sure.
if I run this combination, mathematically I am similar to the full cycle return, or I'm at par with the entire product.
बिल्कुल ठीक
Now,
कह रहे हैं आप. Hmm.
and two, let's say if I have to look at the advisors, now, SIF as a category is quite nascent in India, and particularly what is happening is uh, although it is new to India or Indian investors, these strategies have been in existence for a lot of decades, at least 6 decades in the global market. And globally, this product is particularly, uh, let's say, positioned on an allocation basis. So if I am running, let's say, a certain corpus with me, I want need to allocate maybe 15, 20, or 25% of that corpus to a strategy which is based on delivering risk adjusted return rather than putting even if I get a riskier investor whose risk appetite is very high, I wouldn't give him, ask him to put 100% of his corpus in the riskiest of the asset class. I will still have, a well distributed or well diversified portfolio for him. And that is where I think SIF needs to make
Fits
a
in
cut.
completely. Hmm. Absolutely.
Absolutely.
Absolutely. Wonderful, wonderful. No, I definitely also believe because SIF का एक ऑलरेडी 10,000 ऑड करोड़ का कुछ एम क्रॉस कर गया है जितना मैंने सुनने में आया है. इट्स अ कैटेगरी डेफिनेटली विच इज पिकिंग अप अ लॉट. एंड आपने बिल्कुल सही बात बोली कि यू सी आई एज एन इन्वेस्टर इन अ लॉन्ग ओनली फंड आई मे गो थ्रू ऑल द हाइज एंड लोज एंड मोस्ट ऑफ द टाइम द जनरल टेंडेंसी इज कि जब फंड का लो जा रहा होगा मैं एग्जिट मार दूंगा. करेक्ट. बिकॉज आई कांट हैंडल दैट ड्रॉ डाउन. तो अगर मेरा
That's human psychology, I would say.
हाँ जी.
I'm saying that's human psychology. I
या
mean,
या
9 out of 10
एब्सोल्युटली.
people globally would go through same
या
emotions.
या सो उसमें क्या है कि अगर मेरा ड्रॉ डाउन ही एक रिस्ट्रिक्टेड हो रहा है थैंक्स टू SIF स्ट्रैटेजी देन ऑटोमेटिकली माय चांसेस ऑफ मेकिंग एन ओवरऑल रिटर्न इज आल्सो हायर.
Absolutely. So
इन
your
लॉन्ग.
compounding starts at a higher base.
Absolutely correct. बिल्कुल सही, बिल्कुल सही. That's, I think this is a very, very important takeaway for the viewers here. Wonderful, wonderful. So, well, for our viewers, this is Mr. Rajesh Aynor, investment lead SIF with the Union Mutual Fund. Uh, Union Mutual Fund has launched their new fund of offer of Arthya Equity Long Short Fund. They're launching on 4th of May, closing on the 18th of May 2026. Rajesh, thank you very much, for joining in and for a very detailed conversation, I must say, in terms of what the fund is all about and how all these strategies actually work. So thank you very much for joining in.
Okay, thank you, Surenji. It was wonderful talking to you. Thanks a lot.
My pleasure, my pleasure. And once again, I would like to remind our viewers, very simple to press that subscription button to the YouTube channel of Advisor Coach to keep getting these interesting, wonderful updates. Thank you very much. Thank you, Rajesh ji.
Thanks a lot. Bye. Take care.
Thank you.